Appreciate it. So I want to cover kind of lending principles, policies, especially in these last few years. We've had a lot of changes in kind of mortgage underwriting, just mortgage programs and things like that. So we'll kind of cover some of those, but also would love to hear as we kind of go through too, if you've had issues before, problems that have come up. Maybe we can talk a little bit about some specific scenarios as well. So what we'll cover today, kind of first one is understanding lending principles and policies, just basically analyzing mortgage loans. And won't go get too granular. I don't want you guys to walk out of here with a mortgage license. You know, you guys do something different, right? We'll talk a little bit about the different types and programs. Down payment strategies, I think that's probably one we'll highlight. Because the down payment strategies really plays into how you write contracts, how you make those offers, right? And how to potentially get those offers accepted. The next one, qualification. So if someone has said, oh, they only qualify for this much, you know, we're going to talk a little bit about why or how they might be able to do a little bit more. And then the last one, next to last, the financial strategies is more of like brokered loans, meaning like non-Fannie Mae, non-Freddie Mac type loans. There's definitely some niche stuff out there for people, so we'll talk a little bit about that. And then last one, we'll just kind of finish on the overall market. So what's been going on with interest rates, what's been going on in the market, and hear a little bit about from you guys. So kind of first and foremost, understanding the lending principles and policies. So I would say, you know, when COVID happened, we had a lot of change around self-employed. We had a lot of change in how we determine what they call ability to repay. So those changes all tightened up basically the mortgage industry as a whole. And with COVID kind of policies expiring, majority of those self-employed and majority of those kind of more conservative pieces stayed. They took that as an opportunity. When I say they, I mean our regulators, our Fannie Mae, Freddie Mac, FHA, people like that. They took that opportunity to get a little bit more conservative in certain areas. So it's been a little bit tougher to get financing here in the last few years, and likely it's going to stay this way or maybe even be a little bit tougher in the future. With that said, we've seen kind of debt to income. We've seen loan to value, if you're familiar with these terms. So debt to income would be the amount of debt versus the amount of income. So this might seem very elementary, but the easiest way that I ever explain to A, agents, and B, borrowers is you take your gross income, you divide it in half, and all of your debts need to be underneath that, right? So if the household makes $10,000 per month, all of the debts, including the property, need to be below $5,000 per month. That is the easiest math to have with a client. If you're having a coffee or seeing houses, you know, that's a good, easy way to kind of start into that conversation without getting super granular into their finances. Loan to value. So let's talk a little bit about that. We'll have a little pop quiz. So the FHA, majority people know, is 3.5% down. But I would say one of them is conventional, is what's the minimum down payment for conventional. Happen to know?
Actually, no.
So 3%.
Okay.
So 3%. A lot of people would say 5%.
That's what I'm saying.
Obviously, 20% down to avoid mortgage insurance is, you know, kind of a key one that the majority of people would talk about.
20% for the insurance is like a good place to start, but I wasn't sure
so
how far down. So
3% down when you're a first-time home buyer, you can put as little as 3% down and stay conventional. And it's, you know, mid to late 2023 here, and I would say right now, and take an agreement from the room of a shake of the heads, that sellers don't like FHA. You know, as a whole, sellers don't like FHA. So if you can find a way to have your client stay in a conventional loan, that is usually beneficial. So with that said, people would say, oh, we got to go FHA because they have a small down payment, right? Or they don't really get into the details of it. And in reality, that conventional is only 3% down. So that's a great opportunity when you're having a first meeting, when you're talking with people, that you know you can put as little as 3% down and still be able to do that. While we're talking about those loan to value or that minimum down payment, kind of got to skip ahead and we'll come back and kind of cover these. but there is down payment assistance that can cover that. So for first-time home buyers, non-first-time home buyers, there is an opportunity through the state of Illinois and then lending companies as well. We have 3 or 4 first-time home buyer programs, and we have a couple non-first-time home buyer programs. And essentially what that is if you're purchasing a property underneath a specific purchase price, like right now, that's $581,000. So if you're buying something under $581 and you make enough to qualify for it, you have a 640 credit score, you could get, say, $10,000, as down payment assistance. So there are ways to put as little as 3% down and get some money to cover that. In those cases, if you think about, now we're getting a little more ninja-like in our offers, but when you ask for a small seller credit, they could be coming to the table on the lower end with little to nothing. If you thought about a $300,000 house, 3% is $9,000, so that $10K would cover it. Maybe they have $5,000 of closing costs. You ask, hey, we're gonna offer $300 with a $5,000 credit. They could be coming to the table with $1,000 to $2,000 maybe, right? So there's definitely opportunities. They need to have their own funds, so they're not gonna be able to skate in with $50 in their account and just be able to go kind of paycheck to paycheck, but there's definitely opportunity to structure that. So I would definitely, if you're talking to somebody who's like, well, I haven't really saved for down payment, right? Don't let that be a stopping point, like, hey, that's okay, let's dig into this a little bit more, right? So, and we'll talk a little bit more about that. So let's talk credit scores. So just kind of understanding lending principles today. Typically FHA is going to be at 580. Typically conventional is going to be at 640. So anywhere in there, could they have lower than a 580 and still get a loan? Potentially, absolutely. Could they have a little higher or lower than 640 and still get a conventional? Absolutely, right? But as a whole, if somebody told you they had a credit score that starts with a 6 or a 7 or an 8, they're likely going to be able to get a loan, at least based on credit score. So, all right, let's talk a little bit about mortgage types and programs. And we have, started to kind of dive into this piece as well. So exploring conventional. So let's talk about the kind of loan limits and some of these other things. That conventional is basically a code word for Fannie Mae, Freddie Mac, right? So when you hear those, that's what people usually mean as conventional. They set a loan amount. When I say they, I mean our government, our regulatory body sets that number of what Fannie Mae and Freddie Mac will will buy, right, as a mortgage. Right now, that's $726,000 for a single unit property. Okay, and that's in this area. If you were out in, say, California, that would be much higher. But in our area, in our metro area, 726 is a good number. So when you get above that, that's when you fall into that jumbo loan territory, right? So the benefits of staying conventional, typically very straightforward in terms of underwriting, typically less documentation, which is ideal. When you get into jumbo, if you think about this from a jumbo perspective, you might think, it's more difficult to get the loan. Potentially, there's more documentation needed. But what I want you to think about when you go into a jumbo loan is that they make their own rules. It's their money, meaning whoever the jumbo investor is, whoever that lender is using, and they can make up their own rules. They don't have to follow what Fannie Mae say, Freddie Mac says. There could be some illogical policies, which could be in the benefit or the curse of a client. So, when you get into the jumbo, if you have a listing or if you have a buyer that is jumbo, that is the time to be really connecting with the lender in terms of, are they able to do this? Why are they able to do this? Typically you're gonna need 2 years of tax returns. You're gonna look at self-employed income different. You're gonna do all kinds of things are gonna be slightly different when you come into that kind of upper threshold, right? If you have a listing, I would be asking, questions of, is this a jumbo or conventional? So if you have $1 million listing, and they have 20% down, they're staying jumbo. But if they have 30% down, they're conventional. So it should be a little easier to qualify on the conventional. So all of a sudden, if I saw 30% down on a pre-approval letter, I'd be like, okay, they could probably make this work. Not only is that good down payment, but that's also a little easier, probably less documentation, a little more streamlined. So while we're talking about the conventional to jumbo as well, there's typically a small disparity between interest rates. And there is no, I don't want to say there's a rule of thumb here, because I've been doing this almost 15 years. And for quite a while, jumbo was more expensive. Then jumbo became less expensive. Then jumbo and conventional were the same for quite a few years. And now we're back to jumbo being a little cheaper than, say, a conforming loan. So there's definitely a benefit and a consequence at times of being between that loan amount. I remember years and years, I would do loan amounts at $1 over the loan limit between jumbo and non-jumbo, because you could get a significantly better interest rate.
Right.
So they wanted to take a lower loan amount, but we looked at it and said, let's take $1 more than wherever that threshold is, and then that would obviously give us better terms that they can do. So, questions so far, guys? No? Awesome. Well, we're just burning right along. So, let's talk about down payment strategies. So we did talk about a little bit of the potential for, say, like a first-time home buyer to get in for, little to none. Some of those things that you want to think about, though, when you're talking about down payment strategies and, kind of creative ways to write that contract, is keep in mind when you're asking for that credit back from a seller that we still have to appraise for that overall value, right? So that then comes into play where, let's say we're offering $300,000 and we want $7,500 back. Really, that's a $292,500, purchase price, right? That's what the seller's netting at the end of the day, right? But that means we still have to appraise for that $300,000. So I'm always asking the question as the lender, asking to the buyer's agent, saying, hey, if we are going to go out there and ask for this seller credit, then how confident are we that we have a lot of comparables to be able to match up for an appraiser, right? Because that's when they were pushing it a little too hard. There are maximums in terms of how much credit that you could be getting back from a seller. So typically in conventional, that is 3%. So 3% back. Okay. But again, that's probably, if you're looking at a $500,000 loan and you're getting 3% back, you've got $15,000. You're on the edge of not appraising, because that's,
right.
Again, appraisers, I've said this for a long time, is appraisers are trying to get within 1 or 2%, because that's opinion by the time you get down to that, last few percentiles, right? I've always laughed of, let's say you have a house for $600,000 and appraised for $595, and I'm just laughing, going, how can they get down to less than 1% and not be able to get that, right? That's their job. With
Right.
that said, 3%, that's a big number, especially on the higher end, right? So you definitely want to be conscious of that. FHA allows for more, but again, probably even more problematic if you're going down an FHA loan path and trying to get quite a bit back. When we're talking about the down payment strategies as well, I would encourage everyone in a first conversation, when you kind of get into a little bit of the numbers, and again, you don't want to go, get into the mortgage side too deep, necessarily, but ask them if they have 1% of their own funds. So if they're buying a $300,000 house, do you have at least 1% like sitting in your checking and savings today? Yes, great. Then you're going to qualify for quite a bit of stuff then, and then that way you are kind of, no, not really. Then you likely know there's going to, you're going to have some conversations with gifts, and there might be a longer timing for them to save money, or maybe we have to come down on their price point, right? Or they're just not ready to buy yet. But with that said, some of those initial questions that I'm asking is, do you have 1% of your own funds? Is it checking? Is it savings, right? The rest we can figure out. We can get creative. We can write contracts up to do that. So while we're talking about down payment strategies, or kind of, opportunities to, be creative on the, the offers, let's quick show of hands here. Have we waived appraisal contingencies lately, right? Do you know when you're making an offer, appraisal contingencies? If you have a low down payment borrower, that basically means they have to bring in the entire gap that you could be, doing, right? Mm-hmm. So 80% of the time, it's probably not going to work for the low down payment. I'll tell you a quick story. I was on a call with a client yesterday, and we were talking about how they were considering waiving an appraisal contingency for an offer. And I was like, guys, we're putting like 35% down. If it doesn't appraise, why do you get, let's run through the math real quick. When they have larger down payments, when you have 25, 30% plus in a down payment, if it appraises 1, 2, 3, 5% low, they still have enough equity in their offer, right, to be able to avoid mortgage insurance and likely have zero change in their terms. Now, maybe their ego is a little hurt because it didn't appraise, or there's a tough conversation with you guys of like why you offered this and why it only got here. But with that said, if I've got a 25% down conventional client, I'm probably encouraging them to waive the appraisal contingency most times to stay uber competitive, right? Because there's not a lot of financial consequence in doing so. Now, let me say this, that is my opinion, sitting in my shoes, working for my company, working with appraisers that I know and trust. If I'm working at a national bank, let's say, and I have to use an appraisal company that is nationwide and I'm finding a lot more low appraisals, that might scare me a little bit more. So understanding the lender that your client is using and having a quick conversation, I would definitely encourage you guys to reach out to the lender and say, we're thinking about waiving the appraisal contingency because we have such a large down payment. Do you have any issue with that? And just see what they say. Like, ooh, yeah, then you already know, maybe we'll be a little careful with that, right? So, but anytime you've got that larger down payment, that is a really good opportunity to, even if it's just something tiny, tiny small, to make it different than somebody else's offer, that's a great strategy to be able to help with that. So, I had a conversation yesterday, and this wouldn't necessarily apply here, but the clients waived their mortgage contingency without asking. They just kind of told me that that's what they did. And they said, what's the recourse here? And I said, well, you cannot walk away if you're not able to acquire that mortgage. And he's like, yeah, that's what the agent told us, but what does that actually mean, right? And I said, okay, let's, take you for instance, John Doe, I said, John, so if you lost your job, how could I qualify you on your income? You'd have to close on this home. You'd have to find a way to come up with enough cash, or you would maybe have somebody co-sign with your spouse, or somehow, some way you got to close on this house or you lose your earnest money. And now I said, if you are at a safe, secure place where you're likely not going to lose your job and you're not pushing your threshold in terms of how much you can borrow, you've got a pretty clean deal. Yeah, you're likely going to get a mortgage somewhere, right? But would I ever say to do that? No, absolutely not. I'd much rather you have the protection in place for that. But people right now, especially in kind of mid-23, are really looking for ways to make their offer as enticing as possible, right? So that's what they chose to do. Not my, recommendation necessarily, but that's what they told to do. Close dates. So we're talking about, making offers and doing some of that.
Before you go to close date, on the mortgage waiver, would it make more sense? Like I said, I was thinking as you're going through it, I will have to get a mortgage. Now I won't get my 7%. I may be paying 12, but if I can afford it, I have to close. Otherwise, I'm got a real mess. But if you put the contingency with a higher rate, now it's 7, so if you make it 8% or 9% mortgage as a contingency, I would think the seller's pretty comfortable. Yeah, he's still going to be able to do that.
Yep.
It's almost like waiving it, but not quite, in case, like say, you lose your job or something. You still have your contingency. It's just you've watered it down for the seller, so it's not an issue.
Yeah, so on the contract, just to kind of rephrase here, not knowing how much got picked up on the microphone, but basically you're saying on the offer, where you put the interest rate in, right, to show the seller that you're going to be able to acquire a mortgage for X percentage rate or below, right? In those cases, if you put 10 on there, that should allow them to feel very comfortable that you can find a mortgage under 10%, right?
Yeah.
With that said, that also relies on the other agent to present it in the same way that you and I are just talking about it.
Okay.
So My only hesitation is that you've got to rely on the other side to make sure and explain how that's a really good thing, that if they're newer, maybe they don't understand that yet. Or maybe they just put it in front of them and say, what are your guys' thoughts? And, don't do as much explanation. If you know the agent on the other side to be solid, has a good business, then that's great. That is a really nice, that is a definitely, check the box of something that's, should make them feel a little bit more comfortable with your offer rather than somebody else. Because I just saw an offer that went in with 7%, and I was like, so we need to chat about where interest rates are at. I was like, excellent credit, blah, blah, blah. I was like, let me take you over onto a search engine and say, average 30-year fixed today. It's going to all start with 7 point something. And you just put on a contract 7.0. So if the seller and the list agent look at that, they're immediately going to look at it and go, how are you able to get a 7 or below? Walk me through that, and what are you going to say, right? Because you're probably not going to get that in a conventional loan, right? So in that instance, like, that kind of potentially could bite them, coming back around. So I do, like, when I communicate with referral sources, I always say, like, when you get ready to make an offer, let me know. Selfishly, I want to know, to stay better in touch with the client, but I also want to make sure that we're putting on the contract something realistic to either, if they are at the end of their budget, then we need to put something probably pretty close, because if the interest rate goes up and they're not able to get it, and now all of a sudden they don't qualify, they got to put more money down, maybe they do need to walk back away, right? Maybe they do need to cancel because they are at the end of it. But for people that are qualified and strong, like, put 10 on there to make sure that they feel super comfortable, and make sure it's explained, because I guarantee you there's some people out there that would explain it of like, well, that's the interest rate their lender is quoting them. That's not correct, because I've heard that as a response before. It's like, hey, I saw 9% on there, and I'm like, oh, they're not going to get 9% for me. They're trying to show you that they don't care where rates are at. They'll take whatever they can get, and they qualify by leaps and bounds, right? Oh, got it. Okay, great. I'm glad I asked. And I was like, yeah, I'm glad you asked too, because that's, instead of being a positive, that almost was a negative. So that's why I do make sure,
think about, because
when you're being conscious of it on your end, you need to make sure that they're being conscious on their end, right? So that's my own, my 2 cents there. So
speaking of rates, when, in your prediction, when do you think that they're going to start going down again, instead of continually going up?
Yeah, so it is August 2023, depending on when we're watching this right now. So the average 30-year fix is in the low 7s. We just hit a 23-year high, according to Freddie Mac. At least I follow Freddie Mac right now. That's kind of the best tool in my mind. So if you go to freddiemac.com, /PMMS is a great weekly chart if you want to go and look at that. But with that said, I would anticipate rates stabilizing at these higher levels, at these inflated levels, likely the rest of this year. I don't really see a use case where we're coming down off that till maybe spring of next year, in my mind. Now, could we see, and again, if we're at the average 30-year fix is at, let's say, 7.25, could we get down to 6.875? Sure, but like, I'm talking like an actual, like, people might be refinancing loans that they're closing today. That's next year at minimum, in my mind, if that makes sense. So could I see them, fluctuate within a range? Absolutely. Good news that inflation's less, good news that our CPI or the Fed said something or whatever, that could definitely bring us down a quarter, 3/8 or something like that. But definitely this inflated range likely for a while. So let's also talk about, and again, this is opinion based, but the general market in 23 versus what we might see, say, summer or end of 24. So with what I just said, I would anticipate rates being slightly lower next year. So some clients have asked, well, I think I'm just going to wait till next year. I'm going to wait till summer. I'm going to let rates kind of come down. And my hypothesis is, very low in inventory. In pretty much all metro markets, including this one, right? We're pretty low in inventory. So I don't see that being solved in any way, right? There's not this new influx of new construction. There's not, rentals turning into condos. There's not any of that right now. So I would anticipate still seeing pretty low supply. If we have a very low supply and we have X amount of buyers today, and we have lower rates, we're going to have double the amount of buyers for the same amount of houses, in my mind. So next year, I would anticipate being a little more frantic in terms of, making an offer, who you're competing against. I would anticipate it still staying a seller's market because they'll be, still very low in inventory. And if you start seeing some headlines that say interest rates at a 1-year low, interest rates coming down, that's going to encourage people at home to maybe get off the fence when they haven't before. And if there's now 3 buyers for every, kind of house, right now there's only 2. Again, I think it's going to be tougher to get that house that's probably worth the same or a little bit more than it is today. So I go and I tell a client, like, that's my hypothesis now. You can compete against more people next year, or you can compete at a higher interest rate today and refinance it next year if rates go down. And if I'm wrong, you still have the house. So I encourage them to always look at that monthly payment and say, what does this equate to? What are you getting for it? But I'm kind of half smiling, thinking, hey, we could have a pretty good year next year if we get it just slightly lower rates. But in terms of this year versus next year, that's kind of how I look at it. So that makes sense.
And approximately how much will it cost them to refinance?
That's a great question. Yeah. So I don't have this down, but let's get into that a little bit more than just that question. So I had this conversation with quite a few people of, what does it cost to refinance? How long does the process take? What's it look like? So, kind of first and foremost, they need to be able to qualify at the time. So if they switch jobs, if they went from salary to 1099, I don't care what interest rates are, they're not going to be able to potentially qualify unless there's a loan program that's going to fit them, right? So they need to be conscious that that could be coming in the future, right? So the overall timing for a refinance, typically when you already own it, you're not dealing with a seller, there's still documentation. You still are originating a mortgage that Fannie Mae, Freddie Mac, FHA, somebody is buying at the end of the day, right? So you still have to get pay stubs, still have to do all the normal stuff that you have to do. There's just really no title, earnest money, all that extra stuff. You already have insurance on it. Typically a lender is going to charge their origination fee of some kind, and that's usually $1,000 to $2,000 depending on the type of lender. You're going to have some title charges, and you're going to have recording fee. Those are pretty much a guarantee on every refinance. You may or may not need an appraisal, especially if it was appraised recently. Especially if they have equity in the property, you're going to probably get an appraisal waiver or just not need one because you could use an old one, something like that. But outside of that, that's really the big crux of it. I would tell people $2,000 to $3,000 as a cost of refinance. Mm-hmm. With that said, that doesn't mean they're writing a check, at the day of closing for $2,000 to $3,000. Now, is there a cost associated? Yes, but let's give you an example. Let's say they owe $300,000 and their house is worth $400,000. You could take the loan out, the new refinanced loan, for say $303,000 and cover that closing cost, let's say, right? So they're going to come to the table with $0 potentially, and in that $0 there was cost associated, and this is what I want to kind of get into next, is lenders will advertise or talk about a no closing cost refinance. So my immediate question is, so who pays Cook County to record the mortgage? Who pays Lake County to record the mortgage? Who pays the title charges? You're saying you don't pull title? Absolutely not. There's always a cost associated. But what they'll do, or what lenders will do, is that if they offer you 6%, right, and say, let's refinance your loan at 6%, I could offer you 6.125, and that extra that the company would make or that the lender would make could offset the closing costs. Okay. So you might have $2,000 of closing costs, and I give you a credit for $2,000. So now all of a sudden it's a no cost refinance. There's still costs associated, right, but your net is essentially could kind of zero out, right? But your consequence is you just took an 8th higher in rate. Right? So there is no such thing as a no closing cost refinance. Now, can you get a credit to offset it? Yes, absolutely, right? So that's just a fancy sales technique in terms of how people will say it. I would say though, when you're talking with clients today, is that hey, you can always refinance a home. it's a couple of grand, and likely if it's a short period of time with the same lender, they're probably going to waive their fee or give you some sort of credit to offset that. So the cost is, you need to ask, but it's not $10,000. I can tell you that, right? So that way, you're like, hey, if you saved $100 per month and my cost was $1,000 in 10 months, you'll have broke even. Like, that's pretty good. Are you going to stay there for a year or more? Great, right? So does that answer your questions on kind of refinance?
Yeah.
So
in terms of how much, when is it worth refinancing? I mean, if you can get, 25, 0.25 less, or what's the
that's
number
tough
worth?
because if you have $1 million loan, a quarter in interest rate is going to probably be enough for most of the people to want to refinance and pay the cost, because it'll save them $300 per month and blah blah blah. But if I had a $200,000 loan, a quarter in interest rate is only going to save me say $50 a month, right? So it's a little bit to each their own. If you do think about this, is when you do a refinance, you're restarting the term. So when I restart the loan on 30 years, based on something that I've paid down a little bit for the last couple years, my payment's already going to be lower, even if I had the same interest rate, because I'm extending the period of time now, right? So I'm already going to get a little bit of savings there, which a lot of time consumers don't realize is like, well, you are extending it out, so that is a little bit of where the savings are at. But I would say it's like, I always look at the break-even point. That's how I talk to that's how I talk through the conversation or that narrative is, how long do you want to stay in the home? 2 to 5 years. Okay. So we really need to, whatever they say that minimum is, I break that in half and I say, okay, I want your break-even point to be 1 year or less. If the cost is $1,000 and you're saving $100, that's 10 months. Check the box. That would make sense. But if you are going to hold that house for the next 2 to 5 years and you're saving $50 a month and the cost is $1,000, and I don't know, I probably wouldn't. I would probably wait till you get a little bit closer. So that's how I kind of look at it. But again, I wouldn't put a percentage on it. I would absolutely, and I wouldn't necessarily say a monthly payment, because to each client is something different. If somebody said $50 a month would be hugely beneficial for us, we could really use it, we're really pinching pennies, then roll the cost back in, and they just took a long-term consequence for a short-term gain. And as long as they're aware of that and understand how that math works, then maybe that's in their benefit. I also have a conversation of like, no matter where you're trying to keep your payment at, property taxes and insurance are going to change every year. Your payment's going to change every single year. As much as you try to budget for a specific number, it's just kind of a fallacy that you're going to keep it under $3,000 or keep it under $2,000, because next year property taxes and insurance change just a little bit. Your policy changed. Property taxes probably went up because they do 2 out of 3 years, or 3 out of 4 lately. So, yeah, I think to each their own. But really, to summarize or to answer that question, is the break-even point. What is it going to cost you, and what are you going to actually save, and then think about it from that perspective. So, by the way, other states could be drastically more expensive or just slightly cheaper. We're probably on the cheaper side, which is probably news to everybody in the state of Illinois that we're on the cheaper side of something. But if you went down to, say, Florida, that refinance could cost $10,000 and it could cost $2,500 here. So it's a bigger deal in some of these other states, than it is here. So, good on that?
Great. Thanks.
Awesome. Let's talk about, I think we kind of got through the down payment strategies. So yeah, let's head on to the next kind of topic here. So qualification and documentation. So, documentation wise, so we talked a little bit about, somebody that maybe shifted from salary to self-employed or something, right? So, or they're new to a job, right? So I would tell you, any of those questions that clients would be asking, assume or pivot back to, let's call the loan officer, and don't answer it, because it is so specific and unique to the scenario that putting a blanket statement on something like that could push somebody that could be a home buyer not into it, or vice versa, right? So we're telling them that they can definitely do that, and then like, oh yeah, sorry, I guess you can't, right? I use this example on some of the lunch and learns and other things, and I said, is this good news or bad news? You've got a client who is an attorney, and that client just, you saw on LinkedIn or Facebook or whatever, they just became partner. You're going to call because, that's really good news. They just became partner at a law firm. But in reality, a lot of times what happens when you become a partner is you now go from salary to now I'm an owner of said company and I'm a K1. You just changed your income stream and there's no necessarily stability of what you're going to make in the future, right? So there's potential for that person to not be able to qualify for a loan or a normal loan for a little while, even though that was great news. It seems like that would be great. And it seems like they just got, make more money. Maybe they want a bigger house. But in reality, like that from a lender's perspective is they just went from something very consistent that I can follow to something that I have no idea what they're going to make in the future, right? So do consider those kinds of things of like when there's changes or when they tell you things that's a little bit of a red flag. Like, ooh, boy, you know what? Let's check, right? Let's verify that that's not going to be a problem. Somebody that went to, I just got promoted, now I'm going to be 100% commission. It's like, okay, we better check with the lender in terms of what they can use. And that's a big deal because when you hear those things, and then let me give you guys an example. So if you had a client that said, I just went to 100% commission and they're using their lender, someone that you don't know, and they issued the pre-approval letter, gosh, step one would be for me picking up the phone and be like, hi, we're working together for Steve. And Steve just told me he's 100% commission. I saw your pre-approval letter. Have you guys got a program that's going to allow for something like that? Has he given you documentation? How is that going to work, right? And diving into that conversation, because that is absolutely significant to a point that could uncover something before you go show them things that could allow them say, ooh, no, I didn't know that. It's like, okay, why did you not know that? That's a whole nother conversation, right? But I immediately, when you hear those little red flags, store them away and or talk to your client and say, hey, have you spoken to your lender about that? Did they tell you that's okay? Have you provided documentation so they can kind of see that in writing of whatever that may be, right? So, the qualification, again, I don't want to necessarily put a rule of thumb on anything, but self-employed borrowers, typically, we want to see 2 years for most lenders, right? We want to see 2 years of tax returns or 2 years of stability so we can kind of follow. If you're salaried employee, you don't even have to have started the new job. You don't have to be there 6 months or 2 years or blah, blah, blah. If you're salaried and you're going to come be an employee of NASBAR, right? And you're going to make X amount of dollars per year, but it's salary, like we could probably close the loan day one, right? As long as we verify your employment. We could close today and you could start a couple weeks from now, right? In the future. Because we know exactly what it is, right? And if you're thinking about it from your perspective, again, don't want to have you become loan officers. You already have a job, but these should all be kind of red flags to say like, hey, hold on, what'd you say? You're starting a new job, but it's 100% commission, or it's hourly and you were salaried before. Again, these are all things that, when people are hourly wage, if they don't have a fixed 40 hours, how does somebody know how many hours they're going to work, right? We go back and look at pay stubs, go back and look over the last year or two of what that looked like, right? So that's where you can be proactive in your approach when you're talking to people or hear them, or you're, kind of walking through, those sorts of things. Mm-hmm. So, let's see. Let's kind of dive in. The next one is advanced financing strategies, but I'm going to kind of tie it into this one. Let's say you have a client that is self-employed and they go to their bank and they say, hey, I can't get a loan. I don't have 2 years of tax returns, or I don't show anything on my returns, right? So agents in the room, you very well could be in that same boat at times, right? I don't show a lot on paper. There are loans, and this is what I call them, this is just my vocabulary, is I would call those like bank statement loans. So basically what we look at is we'd take your bank statement and we'd say, how much money did you bring in right, from your business. How much money did you bring in? And then we would take a percentage of that. So if I brought in $10,000 and I'm in the real estate business, I could probably count 80 or 90% of that for a bank statement loan. If I'm in the manufacturing widget business, that's going to cost a lot more to do my job, right, with manufacturing or something else. Maybe I could use only 50% of that income that comes in. But in that case, let's say I'm manufacturing widgets, I bring $10,000 in, I can use half of it. I now have $5,000 of income I can use for one of these loans that I could not use with Fannie Mae, Freddie Mac, or whatever else because I have to go off tax returns. In these cases, we would avoid tax returns altogether. We would be looking at 12 months of bank statements. That's how we would come up with income. The pro and con here is pro, they can buy a house. Con is it's going to be a higher interest rate. There's going to likely be slightly higher fees, and there could be definitely some niche-y underwriting policies or things because, again, it's their money, a lot like jumbo. It's their money. They make the rules. But I've done plenty of those where I get tax returns, I review them, I say, you're not going to qualify for much because you've taken a lot of expenses off this. But then when we go to a bank statement loan and we look at it and say, okay, I do see a lot of money coming in here, I can now qualify you for, let's say interest rates today are 8%, this might be at 10. Let's say interest rates are at 6, that one might be at 8. 2 to 3% above the market is where a lot of these programs would float. Give you another example. Someone that wants to buy an investment property but doesn't qualify. Like, hey, my lender told me I don't qualify. I have a loan product right now that qualifies based on the property, not the individual, right? So they look at the property and say, this property, the payment is $2,500, but you're going to get $3,200 in rent. Check that box. That works. We're only going to qualify based on the property, not the individual. Now we're going to ask, what is the credit score? And we're going to ask you to state, income and some basic stuff, but we don't get documentation on that. We are looking for documentation on the property, right? So they're very picky about appraisals and rent rolls and things like that, but those programs exist. And again, 2 to 3% above the general market, and you could be getting a loan to buy a new investment property that they walked down to their bank and said, no, you can't do that, right? So do know that those things do exist, but you do have to understand when you're speaking with the lender or when your client's speaking with the lender of who are they talking to, right? Who are they talking to? Are they talking to a conservative bank? Are they talking to a broker that's got all kinds of different options? I'm a hybrid lender, so we use our own money, our own process, our own people. So we're not a bank, we're not a broker, but we do have a bunch of these options in the middle, right? So you got to understand kind of who you're asking and what they do. Does that make sense? Any questions on that? Mm-hmm. So I'm trying to think of other kind of crazy scenarios where people are like, oh, you can do that. So, but those are the big ones, I would say. Let's see. Reviewing documentation, understanding income verification. Yeah, but we'll talk a little bit more about that before we move on. There is, typically when you've got some sort of variable income piece, we're looking for a 2-year history. We're asking 2 years of bonus, 2 years of commission, 2 years of this, right? So there very well could be a very conservative lender that would look at income one way, and then a more aggressive lender that could look at the same client the same way, but yet be able to derive more income. Like I have, used this and, driven my business for many years, that if you have a self-employed borrower that gets qualified for say $400,000 and they want to buy $500, call me. I bet you I can get them qualified for more, right? Because not everywhere is going to look at the income the same way. And the reason being is a lot of the more conservative lenders, and I don't want to throw all banks in there, but most times most of the banks would have a very conservative outlook on how they would calculate income for say someone self-employed. They're just going to qualify for less. That's just plain and simple. But then when you get somebody that doesn't have that conservative overlay or approach or calculation in doing so, then you can qualify for more. You got $4,000 of income here and you got $5,000 of income here, you can qualify for more money, based on that scenario than the other, right? So I do say, like, a lot of times for, for those sorts of scenarios, don't just take it, just don't take it as fact. And what I mean by that is if you're talking to somebody and they're saying, yeah, we're qualified for up to blah, 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 it's like, is that the maximum? Is that where you want to be? Is that where you set the budget? Don't take that as factual information. Ask a couple more questions. And then likely when you peel that onion back, they're going to tell you, oh, that's where we want the monthly payment to be. We don't want to be going any higher. That's going to tell you everything you need to know there. Or, yeah, I kind of wish we would have got qualified for a little more. Then guess what? That's the opportunity to say, well, maybe, you speak with somebody else, have them look at it. It's such a big purchase. If they could qualify for a bit more, maybe they have a program that could be a better fit, right? So, peel the onion back a little bit, I guess, on those. So, let's see. Exploring creative financing options. We kind of talked about that a little bit of, looking at some of those styles of loans, of the, kind of bank statement loans, things like that. One that we haven't necessarily talked about is renovation. So renovation loans exist out there. And typically there's a lot of questions around it. So again, without becoming a lender, here are the kind of bullet points I would encourage you guys to be able to kind of know, is that you can acquire a property for, let's say, $250,000, and I want to put $250 into it, so I have a future value of $500. That loan would close on the day of closing, and the seller would never know anything different. They just get their $250. The other $250 is set aside in escrow with the title company, and then gets divvied up to be able to do that work. So you have to have a general contractor. You have to have, a bid sheet, going from top to bottom on what kind of fit and finish would be in the home. I always say, I don't need to necessarily know what the exact, countertop is going to be in color, but I do need to know how much is going to get spent on it, right? Is that countertop going to cost $500, $2,000, or $15,000? Because that's going to tell the appraiser what they're going to be kind of putting into the property. The appraiser is going out before any work is done, before it's closed, and appraising the property at a future value. Because they're going to look and they're going to see their bid and spec sheet and say, okay, they're going to be doing this. They're going to put a new bedroom back here. They're going to redo this kitchen. They're going to
The views and opinions expressed by this presenter are theirs. They may not reflect the views of North Shore-Barrington Association of Realtors.